Welcome, and thank you for joining our webinar, Key Deal Terms in Today's Middle Market Private M&A Environment. Is the rise of no-seller indemnity deals here to stay? All participants are in a listen-only mode. You're encouraged to submit questions throughout the webinar in the Q&A box, which is located on the right side of your WebEx window. We will do our best to get to everyone's questions at the end. Copies of the webinar recording and presentation materials will be distributed to attendees in the days following the webinar. Andrew, you may begin.
Thank you, Carrie, and welcome everyone to our 8th annual webinar discussing key deal terms in middle market M&A. So before we get started, I'd like to introduce today's presenters. My name is Andrew Lucano, and I'm a corporate partner in Seyfarth's New York office. Joining me, I have Aaron Gillette, who's a corporate partner in our Chicago office. We have Ali Reedy and Matt Weiner, who are corporate associates from Seyfarth. And we also have Kip Wallen, a senior director from SRS Acquium, which is a leading provider of M&A solutions. And finally, from the investment banking world, we have John Rico, who is a managing director at Stout, which is a leading global investment bank. So today we're going to walk through certain of the transaction terms that we surveyed for 2020 and 2021. We're also going to provide a look at first quarter 2022 data and provide some comparisons to what we saw during 2020 and 2021. For the 2022 data, the one thing I would note is that since M&A activity was so high during the end of 2021, there was definitely some spillover into the early parts of 2022. And so I don't know for sure that the first quarter 2022 data is going to really tell the tale of how deal terms are going to play out for the rest of the year, but we're going to see how that progresses. We're going to also discuss today some of the factors that are going to impact the M&A market for the rest of the year. So as everyone knows, during 2020, there was a short-term slowdown in M&A activity due to the pandemic. It was unbelievable because the slowdown was very short-term, and 2020 and 2021 turned out to be incredibly hot for middle market M&A. 2021 was an absolute record breaker in terms of deal activity and deal value. And as our survey indicates, the seller-friendly environment that's been in play for the last several years was certainly still in play for 2020 and 2021. So a few reasons for the hot markets in 2020 and 2021. First, buyers had massive amounts and still have massive amounts of cash on hand to deploy for M&A deals. Also, during those times, we had an ultra low interest rate environment. We're seeing that start to reverse course in 2022. So the combination of low interest rates and massive amounts of cash led to real high competition for the purchase of quality assets. Also, during 2021, there was this fear that under the Biden administration that there would be some new tax laws and regulatory changes. So that kind of caused some sellers, at least early in 2021, to think about, we got to get deals done before these changes take place. So that increased activity as well. Those fears turned out to be largely unfounded because the tax changes never really came. So some major trends favoring sellers. Number one, the market for rep and warranty insurance continues to grow and grow and grow. Almost 60% of the transactions that we surveyed use rep and warranty insurance, and over 50% of the transactions that we looked at for the Q1 of 2022 use rep and warranty insurance. Another major seller trend was the growth of no survival deals. These are deals where reps and warranties don't survive the closing. So the buyer has no recourse against the seller for a breach of representations after the closing. Their sole remedy in these cases is usually to a rep and warranty policy. So a no survival deal is very similar to what you see more in the public M&A space. But it's really gaining a lot of traction, it appears, in private M&A as well. We're also seeing a decreased use of indemnity escrows. Both of the no survival and the indemnity escrow decreased usage will be discussed later in the program. So finally, some headwinds that are affecting M&A activity during 2022. We have inflation rising at alarming rates. We have interest rates rising. We have the war in Ukraine, continuing supply chain problems, and then there's the stock market. The stock market, as I'm sure everyone's seeing, is having high amounts of volatility, and there's a lot of downward movement. And there's also this talk constantly of a recession that's on the horizon. So while the stock market doesn't have really a direct impact on private company, middle market M&A, there's this sort of psychological effect where when the stock market is doing poorly, people tend to address their deal needs a little bit more conservatively. So that sometimes slows M&A. So in an ordinary market, any one of the items I just mentioned could slow M&A activity. Right now, we're kind of experiencing the perfect storm of potential risks. So we're going to see how that plays out. I mean, anecdotally, and at our firm, we're still incredibly busy with middle market M&A. We're curious to see how it plays out the rest of the year. And we're going to be watching these developments closely. And John Rico from Stout is going to provide a kind of more in-depth look at these issues later in the program. And with that, I'm going to turn it over to Ali and Matt to expand on our findings from our survey. Ali, take it away.
Thanks, Andrew. As Andrew mentioned, representation and warranty insurance accounted for over half of the deals that we surveyed. So we entirely separated the insured deals from the non-insured deals while we did our analysis. As you can see, the use of insurance dramatically altered the indemnity terms, and this is the case with the amount of the indemnity escrow. An indemnity escrow is the portion of a transaction purchase price that the parties will place into escrow for a certain period of time after the closing in order to satisfy the seller's indemnification obligations. The use of an escrow largely protects the buyer, as they have an interest in ensuring that there will be funds available in order to meet any indemnification obligations of the seller. An indemnity escrow isn't the only type of escrow that we have seen in private M&A deals. Some deals can include escrows for other matters such as working capital adjustment or a specific indemnity item or liabilities such as pending litigation. But for our data collection purposes, we only surveyed the amount of escrow being held back to satisfy the indemnification obligations of a seller for their general representation and warranty claims. As you can see on this slide, the impact of representation and warranty insurance is profound in the case of the size of the indemnity escrow as a percentage of the purchase price. Of the non-insured deals, 2/3 of the deals had escrows of over 5 to 10%, while an overwhelming majority of the insured deals had an escrow amount of less than 5%. This is surprising because it is fairly standard that the representation and warranty insurance requires a retention amount of 1%, which is typically split between the buyer and the seller. Further, the overwhelming majority of the insured deals having an escrow amount of less than 5% is likely an increase in the no survival deals, which I'll discuss later. Our preliminary analysis of the Q1 22 deals revealed that the indemnity escrow amounts are relatively consistent with our 2020 and 2021 findings, but we were dealing with a smaller sample size of only 13 deals, so it was too early for us to make any definitive conclusions. Moving next to from how much was held in escrow to how long it's held in escrow, the next data point we analyzed was how long all those amounts are held in their escrow. During the sample period, we identified that the median escrow period for the non-insured deals was 18 months, while the insured deals was 12 months. This is consistent with what we found in 2019, and it shows a trend towards continuing seller strength. The escrow period for the majority of all deals ranged from 12 to 18 months, which has been consistent over the last 8 years that we have been conducting the survey. This range is also not surprising because often buyers will want to get through at least one accounting period before they're able to properly evaluate whether or not there's any indemnity claims, while the sellers will push for the shortest period that they can in order to receive their full purchase price. Because of this fact, it's also normal to see that the sellers with leverage will try to negotiate for a partial release of the escrow amount in different intervals so that the entire amount isn't held in escrow for a period, assuming that no claims have been made. We have typically seen this where a portion of the escrow will survive longer for the fundamental representations. These are typically centered around the organization, ownership, and authority of the target company, and then a shorter period for the general representations. Now I'll turn it over to Kip.
Yeah, thank you, Allie. And let me just say it's a pleasure to be here with all of you, and a big thank you to our friends at Seyfarth for inviting me to present some data around no survival. I just want to point out quickly that the data you're seeing on the screen now, this is from the SRS Acquium study, so it's a slightly different data set than what Seyfarth is pulling from for their study. So just kind of keep that in mind. I think it's really great that this data is out there. I think the more transparency there is into the M&A market, these studies really complement each other. But it's also important to know that with any data study, right, you kind of need to take it with a grain of salt, and know that it's really helpful to understand kind of what's going on generally in the M&A market. But for what might be right for your specific deal that you're working on, just remember that it just depends on what the data set is for that particular study that you're looking at. So just to kind of highlight, comment on a couple of things that Allie mentioned. Yeah, we definitely are also seeing a higher use of sort of these separate escrows. So when there is RWI present on a deal, there's a less likelihood that there may be that general indemnity escrow, but we are seeing lots of those deals where parties are setting up special, either special indemnity escrows or particularly escrows for purchase price adjustments or working capital adjustments. I think it's about 72% of the deals in our data set had that separate PPA escrow. And when you look at just the insured deals, it goes up to 85% of those deals. So seeing a lot of similarities there. So specifically getting at what Andrew was mentioning earlier with this increased prevalence of walkaway deals or no survival deals, sometimes referred to as a public style deal, definitely seeing an increase over the last couple of years in buyers willing to structure these no survival or walkaway deals. And so again, Andrew was getting at this earlier. What we're talking about here is, do the seller's representations and warranties survive closing in a way where the sellers would directly be on the hook? So you can have a no survival deal that still has RWI insurance that the buyer could fall back on for those post-closing claims. And also, some of these walkaway deals do have carve-outs or exceptions to the no survival. So you may see survival of fundamental reps, or if there are special indemnities or maybe known litigations, things like that, those can still survive. So when we say no survival, we're talking about, do all of the seller's reps and warranties survive closing in a way that the sellers directly are on the hook in that post-closing period. So in 2021, we saw about 1 in 4 deals being structured as no survival. And on the screen, you can see we also carved out just tech deals. About a third of the deals in our data set are tech deals, so a pretty nice representation of that particular industry. A little less prevalence for walkaway deals on the tech side, but we also see tech target deals not using RWI quite as often. And in fact, for SRS Acquium's data set, it's a little under half. It's about 44% of deals had RWI present, so a little bit lower than the data set for Seyfarth. But looking specifically at these walkaway deals, there's some pretty interesting characteristics going on. So I just wanted to share some data around that specifically, and then maybe get into what we'll get out our crystal ball for 2022. So walkaway deals, they tend to be larger deals. About 83% of these walkaway deals were $100 million or larger deals. And that makes a lot of sense. That these are a little bit more mature companies that maybe are a little bit cleaner deals, the buyer gets more comfortable with a walkaway structure. We also see the median timing to exit for target companies for these deals that are walkaways a little bit longer, closer to an 8-year median. That compares to closer to 7 years across all deals. So again, just indicating that these are a little bit larger companies commanding higher valuations and higher returns on equity invested. Typically, the buyer on these walkaway deals are going to be your financial buyers. So in our data set, a pretty noted presence of private equity buyers, and that seems to be kind of the drivers of these walkaway deals. The strategic buyers may be less likely to agree to this type of structure. For consideration type, a little less likely to use buyer equity, so more of these walkaway deals are using cash. And because these are bigger deals where the targets are obtaining or achieving a higher valuation, very, very few of them include a management carve-out. Just a couple deals in our data set, so kind of within the statistical error range there. The vast majority of these walkaway deals, because they're likely not to have a general indemnity escrow, or if they do, it's probably very small. Kind of to Allie's point, it's usually tied to the retention under an RWI policy. 95% of these walkaway deals included a separate escrow for the purchase price adjustment or a working capital adjustment. So what we're seeing as we go through these numbers, a lot of pretty seller favorable swings, which is not surprising, right? If the seller is able to negotiate for a walkaway structure, probably getting some more seller favorable movement on some of these other deal terms as well. So another example would be the use or prevalence of earnouts on these deals, less than what we would see across all deals. So in 2021, 14% of these walkaway deals included an earnout. That's up just a little bit from 11% in 2020. And also the mechanics of those earnouts, right? A little bit shorter performance periods for the metrics, and the earnouts themselves, the amount of consideration tied up in the earnout, a little bit smaller than you would see across all deals. For these walkaway deals, like I mentioned earlier, sometimes there is a carve out for the fundamental reps. We see that about 2 in 5 deals for these walkaway deals. If there is a general indemnity escrow, the median escrow size was 1%. So a little bit larger than the kind of 0.5% typical escrow size we see for all RWI or insured deals. Shorter survival periods, more likely to have a buyer paid termination fee. 25% of these walkaway deals had a buyer paid termination fee compared to 10% across all deals. So again, just looking at these various deal terms, pretty apparent that when it's a walkaway deal, it's likely, the seller had a lot of negotiating leverage and was able to walk away with some pretty, walk away, pun intended, with some pretty seller favorable terms. For deals that are not walkaway deals, so where there is survival of those sellers' reps and warranties post-closing, and the sellers will be on the hook, we've got some data on how long those time periods last. And interestingly, in 2021, it was just a very seller favorable market last year for M&A, saw that median survival period come down. So typically it had been 15 months for several years. That came down to 12 months in 2021. So when buyers were requiring a survival deal, sellers successful in negotiating some seller favorable kind of mechanics of how that post-closing indemnification would play out, including the length of the indemnification period. Also, interestingly, if you look at that furthest left category on this chart, the less than 12 months category, seeing a few deals, still a minority practice, but a few deals in that less than 12 months bucket. So we did a little deep dive to see what was going on there, because there is a little bit of an increase these last few years. And we're seeing more parties tying survival periods to like reporting dates or reporting periods, as opposed to just like straightforward 12-month or 18-month period. So if a deal is closing in February, maybe they're tying it to a 12/31 survival date rather than a full 12 months. So I thought that was interesting to see parties maybe being a little bit more creative and careful in how they're structuring some of these indemnification terms. For tech deals, for survival periods, we didn't see as much movement. The median was still 15 months for tech deals specifically. So, this is all 2021 data. 2022, things are very different, right? We're just about to see Q2 data. I think, the latest report puts U.S. private M&A down about 40% for the second quarter compared to the previous quarter to the second quarter in 2021. So it's a very different world for M&A. And I think a lot of these seller favorable trends that we saw coming out of the data from 2021 we'll either see those trends reversing or maybe some of those plateauing in 2022. But interestingly, even though sort of the aggregate value of US M&A is down 40%, the number of deals happening is still pretty high compared to 2021. And of course, 21 was a pretty high watermark for M&A generally. So we are still seeing deals get done. Maybe it takes a little bit longer for the deals to close, and valuations are certainly down dramatically this year. But we need to see as these deals are closing and we get into the data, it'll be interesting to see overall, is there a major swing back to buyer favorable terms, or will it be a little bit more subtle? Only time will tell. And with that, I will turn it over to Matt.
I can take this one.
Yeah.
So just going back to the representation and warranty general survival periods, these, as we've been saying, these survival periods typically act as the time limit post-closing for when the buyer can make their indemnification claims against the seller, and this is back for their breaches of representation and warranties. This period varies, and as we've said, there is a recent trend towards shorter survival periods or no survival periods at all. But in 2019, we saw a significant increase of these no survival deals, and our findings for this survey period identified a general decrease in the deals involving an indemnity escrow and continued increase in the deals involving no survival of the general representations and warranties. And this is particularly true with those that have representation and warranty insurance. 4 of these 5 deals surveyed had general representation and warranty survival periods between 12 to 18 months. For both insured and non-insured deals, only 3% of the deals had survival periods of 24 months or more. And this just shows that the buyers are really able to negotiate survival periods for general representation and warranty breaches for longer than 18 months, if at all. Again, this isn't surprising, as many sellers will rely on representation and warranty insurance as the buyer's primary remedy under the purchase agreements for breaches of representation and warranties. I'll turn it over to Matt now to discuss the carve-outs.
Thanks, Allie. As Allie discussed, in connection with our findings related to general survival periods of reps and warranties, indemnification provisions often set a time limit for indemnification claims arising from reps and warranties. General survival periods usually range from 12 to 18 months, though as previously discussed, we have seen a dramatic increase in the number of no survival deals since 2019. The negotiation between buyer and seller regarding which, if any, reps and warranties are excluded from the time limit of the general survival period depends on the nature of the deal, any potential issues determined in buyer diligence, and the related importance of certain reps and warranties to the specific seller's business. Though fundamental reps and warranties are typically carved out of the survival period of general reps and warranties, carve-outs to the general survival period of general reps and warranties tend to be more prevalent in non-insured than in insured deals. This is consistent with the overall more buyer-friendly nature suggested by our data of certain deal terms in non-insured deals, and is also consistent with initial data from Q1 2022. In addition, we have noticed a significant increase in carve-outs related to tax matters, 73% in 2020-2021 versus 59% in 2019, and a significant decrease in carve-outs related to environmental matters from 2019 to 2021, 8% in 2020-2021 compared to 24% in 2019. However, as previously noted, albeit a relatively small sample size, early Q1 2022 data reflects that reps and warranties related to environmental matters are carved out in approximately 23% of such deals, which is consistent with our findings in 2019. Of note, the data in this slide does not include no survival deals where reps and warranties do not survive as a general matter, as the concept of carve-outs to survival periods is not applicable to such deals. Next slide, please. In addition, private M&A deals often provide for an indemnity basket, which limits the indemnification obligations so that an indemnifying party is not liable for breaches of certain reps and warranties unless losses exceed a specified amount. In most deals, indemnity baskets apply only to breaches of general reps and warranties. There are generally two types of indemnity baskets. There are threshold or tipping baskets, and there are true deductible baskets. With threshold and tipping baskets, once a party's indemnifiable losses reach the basket amount, the indemnifying party is responsible for all losses from $1. With the true deductible basket, the indemnifying party is only responsible for losses exceeding the deductible amount. As you can probably tell, tipping baskets are typically preferred by buyers over true deductible baskets because a buyer is made whole for the losses once the threshold has been met with a tipping basket. In our findings, a significantly greater percentage of non-insured deals, approximately 75%, provided for an indemnity basket as compared to insured deals, approximately 47%. Indemnity baskets are more common in non-insured deals than in insured deals because of an increase of no survival deals when rep and warranty insurance is used, and therefore, indemnity baskets are less relevant in insured deals. While both non-insured and insured deals providing for an indemnity basket were more likely to be structured as deductible than threshold tipping baskets, a greater percentage of insured deals, approximately 88%, were structured as deductible than were non-insured deals, approximately 71%. In 2020-2021, we continued to see splits between tipping baskets and true deductible baskets that were generally consistent with those observed in 2019, which are also consistent with early findings from Q1 2022. Next slide, please. Thank you. In deals with an indemnity basket, we also analyzed the basket size across insured and non-insured deals from 2020 and 2021. The median deductible basket size of deals surveyed in 2020-2021 was greater in non-insured deals at 0.8% of the purchase price than in insured deals, which was 0.5% of the purchase price. Note that these percentages are generally consistent with prior years. With respect to tipping baskets, the great majority of deals, approximately 88% of non-insured deals and approximately 83% of insured deals, with a tipping basket had a basket size of 1% or less of the purchase price. With respect to deductible baskets, non-insured deals surveyed had a much higher percentage of deals with a deductible basket of 0.75% of the purchase price at 48% than did insured deals at 31%, which is also consistent with prior years. As you can see on this slide, note that a limited number of deals had an indemnity basket size in excess of 1.5% of the purchase price. These deals were subject to unique facts and included certain terms that vary from market terms in the other deals surveyed. For example, the great majority of these deals were in the oil and gas industry, so you could see that the specific industry of the deal or of the business does have an impact on the specific deal terms. And this goes to show that the specific facts and circumstances of each deal will often carry the day in negotiations, even if not necessarily market. Next slide, please. Another key element of the negotiated indemnity package is the indemnity cap. The indemnity cap limits a party's maximum liability under the indemnification provisions to a specific agreed upon dollar amount. The amount of the indemnity cap is often equal to the escrow amount, if applicable, or a similar percentage of the purchase price. Whether insured or non-insured, most deals provide for an indemnity cap on breaches of general reps and warranties, though indemnity caps are much less frequently applied to fundamental reps, which may be uncapped due to the essential nature of such reps and warranties, or may have higher caps than the caps applicable to the fundamental or general reps and warranties. In 2020-2021, approximately 75% of non-insured deals and approximately 60% of insured deals provided for a cap on recovery for breaches of general reps and warranties. However, excluding no survival deals, almost all, approximately 98% of non-insured deals and approximately 96% of insured deals provided for a cap on recovery for breaches of general reps and warranties. So just in these numbers alone, you can see the large impact that the increase in no survival deals is having on corresponding deal terms. And with that, the fact that fewer insured deals provide for a cap versus non-insured deals ties back to the fact that more insured deals are no survival or non-recourse to the seller than non-insured deals, which eliminates the need to cap indemnity exposure. Though the percentage of non-insured and insured deals with an indemnity cap in 2020-2021 is consistent with 2019, the percentage of deals with an indemnity cap has decreased since 2018. As previously noted, this decrease has been in large part due to the continued increase in no survival deals, which again remove the need for an indemnity cap related to reps and warranties. Of note, indemnity caps are usually dramatically lower in insured deals than in non-insured deals. The median indemnity cap for insured deals in 2020-2021 was 0.6% of the purchase price versus a median indemnity cap of 10% of the purchase price for non-insured deals. As is evident when compared to non-insured deals, the use of rep and warranty insurance will typically reduce sellers' indemnity cap under the purchase agreement, which is due to the fact that buyer can seek recourse under the rep and warranty insurance policy. That concludes our indemnity deal terms summary. Next, Aaron will discuss our findings around fraud and a few other key areas.
Thanks, Matt. We'll jump right in here to discuss fraud. Private target middle market acquisition agreements often include fraud exceptions or carve-outs on buyers' indemnification rights and remedies, such as a fraud carve-out for the caps, baskets, and survival periods that Allie and Matt have been highlighting here. And so for that reason, unless fraud is carefully defined and negotiated, seller may find itself subject to post-closing liability for more than intended by the fraud exception. This is particularly true in a walkaway context when a seller has an expectation that they aren't going to have liabilities other than perhaps for a carefully defined fraud. In the alternative, a buyer may have unintentionally limited its available remedies by not carefully reviewing the fraud definition and exceptions. You can see from the slide here a few examples of fraud definitions based on the agreements we reviewed, ordered from most to least seller protective. So you can see whereas the sellers prefer precise fraud provisions, which limit the potential for fraud claims as much as possible, buyers prefer a broad fraud provision, which encompasses the most conduct possible. So at a high level, you can see sellers are going to prefer a very defined, lengthy provision. Buyers probably more likely short and sweet to keep it broad. Some key points to highlight for you from this slide, starting at the top. Sellers want a fraud definition that requires intent, clearly defines intent, limits the reps and warranties to be considered in connection with fraud to those within the four corners of the agreement, and limits the universe of individuals capable of committing fraud. On the other hand, buyers want a fraud definition that does not as clearly define intent and does not limit the reps and warranties to the four corners of the agreement. Next slide, please. So turning to the data on fraud from our survey, in particular in the non-RWI and RWI context, you can see on the slide starting at the top right in green, whereas approximately 97% of insured deals surveyed in 2020-2021 included fraud exceptions to certain indemnity provisions. This is consistent with 2019. Approximately 92% of non-insured deals surveyed included those fraud exceptions. So which is actually an increase from about 83% in the prior year surveyed. So one view here is that the increase on the non-insured side is actually a result of the increase in rep and warranty deals, and sometimes terms that are more standard in the rep and warranty context have actually spilled over a little bit into the non-insured deals. So we'll see if that trend continues into the next survey. Working our way down on the slide for the definitions of fraud, insured deals were much more likely than non-insured deals to define fraud. It was 89% in insured deals, only 48% in non-insured deals. In both cases, though, we did see an uptick from 2019, and in particular on insured deals where the definition of fraud is increased significantly, almost 20% since 2019. For the fraud exception to limited to the four corners of the insured deals that define the term fraud, approximately 69% limited fraud to fraud within the four corners, which is consistent with prior years. It's slightly less on the non-insured side, which is right around 55%. Finally, on the intent prong, though insured deals were more likely to include a fraud definition, a similar percentage of insured and non-insured deals included an intent prong in the fraud definition. Next slide, please. Thank you. So we'll turn to some other key deal points that we focus on in our study this year to highlight them. And we'll start with earnouts, also known as contingent consideration. So the deals surveyed in 2020, 2021, approximately 15% included earnouts, which is consistent with 2019. On this data point, we'll see if it continues in 2022. I think, based on our experience, a little surprised that number didn't increase from 2019. So we've seen quite a few earnouts, which has largely been driven by as a way to bridge valuation gaps in a seller favorable market. On earnouts as well, on the deals surveyed, approximately 73% of the deals provided for earnouts amounts in excess of 10% of the purchase price, which is also consistent with what we're seeing in the market. We've had several deals above that 10%. Even some deals go as high as 40 to 50% of the purchase price. Next, we'll talk about the seller retaining the attorney-client privilege. And this deal term would only be applicable in an equity transaction, meaning where the buyer is taking over the existing target entity and the rights and privileges that go with it. In this case, a seller would typically want to ensure the attorney-client privilege for all communications between the target and seller's counsel during negotiation remains with the seller rather than the buyer. And based on the data we studied, approximately 82% provided for seller retaining the attorney-client privilege in a non-insured context, and in insured, it was a little bit higher at 91% for the seller retaining that attorney-client privilege. And our last point we'll highlight here is in the bring down closing condition, which provides the buyer with the right to walk away from the deal if any of the seller's reps fail to be true and correct. And the distinction here is usually between a material adverse effect, or MAE, or in all material respects, which is a slightly lower standard. And in this context of the deals surveyed, approximately 76% use the material adverse effect qualifier, which is slightly increased from 2019, and 24% of deals use the in all material respects qualifier, which is slightly down from 2019. And again, this is an example of a seller-friendly transaction market where a seller prefer the MAE qualifier used. So lastly, for today's presentation, John's going to give us his current insights and observations from the investment banking side.
Great, thank you. So, what is our view from being on the ground? It's been a fascinating run. So just as context, we are predominantly sell-side M&A, mergers and acquisitions, and we operate within the middle market to lower middle market. So think, deals anywhere from 150 to 250 in total enterprise value in the upper end, down to 50 or so in the lower end. And if you look back 10 years, 12 years from today, when is the last time we had a significant recession, putting aside COVID? The world has changed dramatically. First, we spent a lot of time talking about rep and warranty insurance, and that really has been a game changer in terms of getting to a successful close and reducing the seller risk post-close due to an escrow. And so that's been wonderful. And I, as we think through what 22, 23 will bring, I don't see the use of RWI changing. I think it's been a game changer, and the benefits to both buyer and seller are so self-evident that I do not see that changing. Whether the public company style deals, walkaway deals changes, that probably will on the margin. But I don't think the use of RWI is a function of seller leverage. I think it's just a function of the quality of the product. Again, going back 10 years or so, as I said, the world was different. You had less committed capital from an equity and debt perspective. The number that I remember off the top of my head, you had a capital overhang, so equity that was raised but not deployed, somewhere in the $500-600 billion range, right? Today, that number is most certainly over $1 billion, and that's just equity. And then how about the debt? On the debt side, there has been a number of committed funds that have been raised since then. I don't have a number beyond for that, but the debt markets today, whether it be senior plus mezz, which is a bit out of favor, versus the unitranche structure on the cash flow lender non-bank side, both in terms of structure, availability, and cost of capital, has never been lower. Now, as you think through the rising interest rate environment, that is a concern. It's not nearly to the same degree as you would have a pullback in the availability of debt, right? So just to state the obvious, if you were buying a company for 10 times earnings before interest, taxes, depreciation, and amortization, EBITDA, and you're assuming you're going to be able to achieve 5 times of that, 50% of the purchase price in debt, if you can only get 4 times, that's going to have a 10% decrease in the value, right? Just kind of simple math. So as you look at the current debt markets, and these are rapidly evolving, and depending on what lender you talk to on what day and maybe even what hour, we have not seen for the middle market and lower middle market deals, and here I'm going to use the definition of, say, $100 to $150 million of enterprise value and below. We have not seen a dramatic pullback in deal structure, debt availability, and pricing, right? It's pricing's coming up, but it hasn't really moved the needle. And you might see a small pullback, maybe a quarter to half turn, but nothing dramatic. On the larger deals, certainly anything that's rated, you're going to see those debt markets have all but frozen. So it's pretty remarkable. It's really hard to say what that means for 22. Kip said, and I don't have the data yet. Q2 volume is going to be down. That's possible to probable. We have not seen a decrease in valuation multiples yet. The one caveat there is, a lot of things go into the valuation equation. You have, company-specific factors, you have industry-specific factors, and you have a general macroeconomic. If growth stalls to declines, you will see multiples come down. There's no way around it. The fundamental repricing of risk on the equity side, where equity players would have 10 years ago said, I'm going to require an internal rate of return of 25%. Today, or at least last year, they were pricing their equity at 15, 17%, maybe a little lower. And just like a bond, as quote, yields go down, pricing goes up. That repricing of risk may or may not occur. But again, it all comes down to supply and demand. If there's enough pressure to deploy capital, you will not see a dramatic decrease in valuation multiples. But it's an interesting time. As Andrew said, last year in 20, we had a shutdown for a quarter or two of deal activity. And then there was pent-up demand. And then, of course, as Andrew said, we had the pending tax law changes, which never quite materialized. It's just, and then you have supply chain disruptions. It's going to be very interesting what happens this year. The prospect of a recession is certainly stronger than it has been in the last 10 years. Goldman, the latest research they published is, they're saying a 30% probability of recession the next 12 months, and then another 25% if we don't have one in the year. So they're predicting a 50% plus or minus probability of recession the next 2 years. Lenders, credit committees are all factoring that in. Certainly anything that has even the sniff of cyclicality is going to be challenged going forward. If you look at the macroeconomic picture and you think and you realize that 70% of the U.S. GDP is driven by the U.S. consumer, And if your view, which happens to be mine, that the U.S. consumer is a bit battered right now. You know, there's no stimulus, cost inflation, you know, fuel, hard goods, soft goods, food is all, you know, trending at levels we haven't seen since the late 70s, early 80s. And if you look at the public company stocks on the retail side, they're getting, you know, their heads handed to them. So it'll be interesting what happens. The offsetting to that is, of course, that unemployment is still at record low levels and wage inflation is still keeping up with inflation. So it's going to be interesting. I don't see, you know, if we do have a recession, hopefully it's quick and fast. No two recessions are quite the same. But again, back to the, you know, commercial here. There's the fundamental drivers of M&A activity are there, but there's a strong possibility that either we're in a recession or about to head into one, and that will dampen appetite for a period of time. Whether that's, you know, second half of this year or early next. And then last thing I'll close with, if you talk to other colleagues in other service lines, I'm thinking here of the quality of earnings analysis. The quality of earnings industry is still operating at or near capacity, which means on the sell side, which means there are still a number of sellers that are trying to get their deals done. You know, last year it was taxes. This year it's likely that volume is a function of the pending recession, and so we'll see what that means. But I'm not ready to throw in the towel that you know, second quarter, third quarter will be falling off the cliff yet, given those factors.
Thank you very much, John. That was great. And you know, we're out of time for the Q&A, but we're happy to respond to any questions you have via email. The CLE code for this program is SS, as in Seyfarth Shaw. So it's SS6370. So I hope everybody enjoyed today's webinar and learned something. 2022 should be a very interesting year, to say the least. And we look forward to seeing you again next year for our 9th annual webinar for our survey book. So thank you, everybody, for attending.